Welcome back. We have an update from Ascend Wellness Holdings, trades on the OTCQX under the symbol AAWH, and owns and operates state-of-the-art cultivation facilities, growing award-winning strains and producing a curated selection of products for retail and wholesale customers. It's great to have Ascend back, and it's been a while. Let's introduce its CEO, John Hartmann. Welcome back, John.
Thank you very much for having us, and good to see you.
All right, tell us a little bit about what Ascend does.
Ascend is a 7-state operator in the cannabis space. We're primarily located in the Midwest, Northeast, and recently the Mid-Atlantic. We entered Maryland just about 1 year ago, our 7th state, and we currently operate 38 dispensaries in those seven states. 5 of the states are recreational, adult use recreational, and 2, Ohio and Pennsylvania, remain medical for the time being.
And you joined Ascend a little over a year ago. So tell us a little bit about your background and what motivated you to join the company.
Sure. My background is primarily traditional wholesale, retail, and a touch of manufacturing. I started my corporate career in pharmaceutical distribution, so a highly regulated industry. And then I worked for some major manufacturers like Home Depot. And I think the fit for the role is what attracted me to Ascend, and really what resonated with me the most about the company is the foundational strategy of the business. So the company's about 5 years old, and has been growing through M&A activity, very careful and considered M&A activity over that period of time, focusing on late-stage medical use markets and early-stage adult use markets. So in response to your first question, I shared that we are in 7 states, 5 of which are both medical and adult use, and 2 that are medical only. So in the state of Ohio, which is past the state approval for recreational use, we are currently going through the regulatory changes to be able to sell our products in the recreational market there, and we expect that Pennsylvania, our 7th market, will transition to adult use about sometime later next year. So it's really been a very I guess a good way to provide an example is we haven't been the company that's gone out and tried to put a flag up everywhere. We've focused on these very discrete markets, 7 for us so far in counting, to really build our vertical integration and leverage our investments in that way.
Thank you for that. Now, Ascend recently announced some significant news, raising $235 million in senior secured notes to refinance your existing term loan. So share more about this transaction and its implications.
Yeah, very happy to have this behind us. The smile on my face is very genuine. We purposefully set out on this journey to refinance the debt. We started actually late last year. And really ramped it up over the last few months. Our initial debt holding of the company was a $275 million term loan, which started in 2021 and became due in August of next year. So for the audience, those in the audience that are fiscally kind of tuned in, when a long-term debt becomes current, meaning it's within 1 year of its due date, it appears differently in your financial reporting. So for us, it was critical that we wanted to get the refinancing behind us before that debt had less than a year to go. So the terrific news that we have it behind us. I think the other really exciting things for us here are that 4 of our largest term loan holders, 4 of our largest previous debt holders are the substantial majority of this new bond offering that we just completed. And that is an additional part of the difference between our former term loan and the current debt structure, is that it was a notes offering in the form of a bond. So we now, our debt will now trade as a bond. It's tradable. It hasn't traded, but it will now can trade as a bond, which is a kind of a more mature way of thinking about the debt facility for a company like ours. So in cannabis, I think someone has in the media, we've read that this is, the largest piece of debt that's been closed in the cannabis industry in the last couple of years. I think the terms are certainly market. We're very, very pleased with the flexibility that this provides us as a business. It has a 5-year maturity, so it's we don't really need to think about this until 2028 or so, a year or so before it's due in 2029. And what's really exciting about it is we used the $215 million net from this offering to pay down the prior term loan, and we're able to carry the balance of that initial term loan to its maturity date at the lower interest rate that it was carrying, because obviously several years later, we all know the interest rate environment is higher than it was several years ago. So a lot of good things here around the confidence that the debt holders are showing in our business, as well as the flexibility that this new structure provides to the company.
Terrific. And considering that capital in the cannabis sector can be harder to secure and often comes with higher rates, like you mentioned, how do these rates compare to those of other cannabis operators?
Terrific question. As I alluded to, I'll be a little bit more specific. I think to put it in real perspective, our term loan interest rate was 9.5%. We know that since 2021, the interest rate environment in the U.S. and primarily throughout the world is dramatically higher. Thankfully, our new interest rate is 12.75. So it has gone up, but it's not, it hasn't gone up as high as some thought it might. So the terms are very reasonable in the context of the cannabis industry. Obviously, the cannabis industry, because of the lack of available investment in this industry, we do pay higher interest rates than other corporations. I think so very comparative terms to other big deals. The bond structure that I mentioned to you is a very unique one for us, and I think for the industry. And we're excited to have this now behind us.
Well, congratulations on securing such a favorable deal. Now, 5 years of runway ahead. What are you most excited about for Ascend's future?
We've been very focused on continuing the growth story of the organization. As I mentioned to you, we added our 7th state just a year ago. That's the state of Maryland. We have, as again previously mentioned, we have Ohio and Pennsylvania on the cusp of becoming adult use. That's meaningful for us because once the markets open up for beyond the medical only use, we usually see a 2 to 2.5 times lift in revenues, and so it's a very meaningful way of leveraging investments that have been made in these states. So we're very focused on continuing growth at the right pace. We're also very focused on cash generation. So we're in a bit of a quiet period right now because we have our earnings report in a few weeks, but we did announce at our prior quarter close and at the Q1, continued focus on generating cash, free cash from operations. I believe it was our 5th consecutive quarter. And we've been very public about our commitment to cash generation, to free cash flow on an annual basis, and that really is an important mark for us. Important is revenue growth, of course. Important is EBITDA, but also really the ability for a company to stand on its own, generate cash, and really be able to pay down debt and invest in future growth opportunities.
Now, Tom asks, when you say growing through M&A, he assumes you're making acquisitions. So what do you do with, is it stock? What exactly do you look for? Any specific criteria?
Great question. Thank you for the question. Our current M&A is focused on acquiring new dispensaries. So in the states that we operate, we look for new locations that are available. We look to achieve the maximum number of dispensaries that a state allows. And then we also look to support partner dispensaries where we have a supply agreement to provide our grown, cultivated, and produced manufactured goods, but also support partnership stores with everything from a wide variety of managed services that adds to our overall consolidated revenue. But the primary focus of our current M&A is on acquiring new dispensaries. And the best example I give you is we bought 4 dispensaries in Maryland when we entered that market 1 year ago.
And Cameron asks, what's the annual interest expense saved by the restructuring?
Well, the cost of capital is actually a little bit higher. The cost of capital has gone up, from a base interest rate to our new interest rate about 300 basis points. But what the flexibility of this structure allows us to do is pay off the remaining $60 million of the original term loan, allow it to ride all the way to maturity of August of next year at 9.5%. And then obviously because of the increase in interest rates environmentally, not particular to us, but just generally speaking, our cost of capital does go up for the $235 million. However, we are able to, with no prepayment penalty, we're able to prepay in the first full 2 years of this bond at no additional charge, as well as in the 5th year at no additional expense. So we've got a lot of flexibility, despite the fact that the interest rate environment did go up. We have a lot of opportunity to pay off the remaining $60 million, and then as the environment changes, as interest rates come down, perhaps we have an opportunity to look at how we might refinance this in the future.
Absolutely. John, thank you so much for joining us, and great update.
Thank you very much for having me. Have a wonderful afternoon.
Thank you too. All right, everyone, stay with us. We'll be right back.